An important fundamental voice. Pramod Gubbi, founder of Marcellus Investment Managers, joins us right now on the show. Pramod, good having you. Thanks so much for joining in. A few things have happened from the time that we spoke last until now. There is a clear mandate. There is a very dovish central bank. And there have been some accidents within specific companies, but well, that's not new now. India has been seeing that for the past 6 months. What's your view now after that big event is out of the way now?
No, I think it's important that the government has come back with a mandate because it's about time we take some difficult measures, difficult reforms to get the economy back on a firm footing. All these years, the economy has been held up by a single engine, as they call it, the consumption piece, and the events of the last 6 months, particularly around the NBFC issues, have clearly hurt the consumption engine itself. Remember, liquidity is something which keeps the economy running, and the NBFC issue has caused a liquidity crunch of sorts. Although there is not an issue in terms of systemic liquidity, it's about directing that liquidity to the very engines of the economy, and that's clearly, we've seen that in the results for Q4 as well. Well-run companies have also reported some slowdown in terms of growth, even in some sort of product categories which are considered to be staple in nature. That suggests that there's not much of an issue as far as demand is concerned, but the whole supply chain which works on liquidity-driven working capital financing, that's come to a halt. I guess you need to break it up into two bits. Right now, we need to look at the here and now. If we can resolve the liquidity issue, the NBFC issue, park whatever bad assets, recognize them, and get the rest of the economy growing, at least it'll be, that's the need of the hour as far as the short term is concerned.
But what if all of that doesn't happen in a bunched up fashion, happens over a period of 6 to 9 months, which we may not know? What should investors do in such a scenario then?
Well, I mean, if you delay the fixes, then I guess we could see some more problems cropping up. As we've seen in the past, it goes in a cycle. You have a liquidity issue. Some performing assets can turn non-performing simply because of the liquidity issue. So liquidity crisis results in a credit crisis. So, whoever needs to act with a sense of urgency here. So you can't have a prolonged solution to this. So you need to stem the rot now, and that'll fix the temporary issues. From a longer-term perspective, of course, there are reforms which, all of us have talked about. I think in some ways this government in its previous tenure has also made some steps towards it, but I guess we're at a stage where those steps need to be acted with a sense of urgency and perhaps with a lot more intensity.
Pramod, what are you advising clients? Because if you see only a few handful Nifty stocks are managing to move the index, but somehow the mid cap and the small cap end of the market has not played out. People thought that if they fall 30-40%, we should accumulate. They did, and still from there they fell 30-40%. So how should one be different? How should money be made? What are you telling your clients?
No, I mean, I think in the long run, like we say, if you're investing with at least a 3-year horizon, ultimately earnings growth is what drives your stock price returns. Yes, there is some hidden value in some stocks, but for those stocks to perform, perhaps you'll need a much more broad-based recovery, both at the economy level and hence the sentiment rubbing off at the market level. As of now, I think the market is reflecting what should be the case. There's only a handful of companies which are still sustaining some degree of earnings growth, and that's where most of the money is flowing. And like I said, unless and until we fix the short-term and the long-term issues, a much more broad-based recovery in the market where you can extend yourself into more small and mid-cap names should be held back.
You're saying that don't invest in mid-cap as of now?
Well, I mean, I would say small and mid-cap in general. Like I said, ultimately you need to look at earnings visibility. Now, earnings visibility, it so happens, slightly better in some handful of large-cap names. But at the same time, not all large-cap names have the same sort of earnings visibility. Similarly, there'll be a handful of small and mid-cap names which can demonstrate that. So ultimately, it is the earnings visibility which should drive your investment behavior rather than the market capitalization itself.
Okay. But would you believe with some of the actions and the statements that have been put out by some of the troubled NBFCs that we are near the nadir when it comes to the problems and the resolutions are taking shape? Because for all the brickbat that it receives, DHFL has made payments, maybe some with a delay, but they've made that. India Bulls keeps on constantly releasing those data of how well funded and adequate it is. We all know that they're not disbursing money, they're holding on the cash for a rainy day, etc. Are they doing the right things? Is there equity value? Is there equity money to be made into some of these troubled NBFCs?
Well, I hope they're doing the right things, and I hope we are near a solution. But from an investing perspective, I think at least from our fund philosophy perspective, we will not bite these unless and until most of the issues are behind. You know, if we take a call now, that will amount to some sort of speculation. Because we have very little information of what's happening inside. All we can do is decipher as to what's happening. So maybe if things are sorted out, you will get a better opportunity to get in. Better in the sense, not from a price perspective, but from a risk perspective, right? There is certainty of a recovery, and then you know, you can definitely invest in these stocks. But at this stage, I think it's too much of a gamble to look at these stocks.
Okay, are you looking at autos actively, Pramod? And the bigger question, and the debate rages on about whether this slowdown is structural in nature or cyclical in nature. And while we hear an RC Bhargav saying that from August the demand will bounce back, I don't think anybody, except for maybe the auto companies who are experienced, I don't think anybody is equipped enough to say with certainty that I know for sure that this is structural, or I know for sure that this is cyclical and it will bounce back. I don't know, how do people make those comments in the first place?
Yeah. I mean, absolutely right. I think there's a mix of both. There is an element of cyclical slowdown. Clearly, auto is one sector which thrives on credit supply. And given the credit supply slowdown in the last 6 or 8 months, you would expect a slowdown of these sorts. But then, this is almost unprecedented. We haven't seen this. It's not like we haven't seen a liquidity crisis in the past. So there could be an element of structural aspect as well, be it, the car ownership itself. There is plenty of data in the Western world which suggests car ownership levels are going down. We are seeing anecdotally millennials in India are also being averse to car ownership. So there is an element of that, but I don't think things have changed so dramatically that we're seeing a 20% decline year on year. So the truth, like always, lies in the middle. It will eventually recover. The question is, once the recovery happens, what sort of companies will benefit from it, right? Because in the whole macroeconomic growth situation, we tend to ignore the competitive or the industry structure element of it, right? So there are various new competitors coming in, particularly in passenger cars. So passenger car category as a whole might recover, but does that necessarily mean that you go ahead and invest in companies? I think that's a very incomplete investment case. So you'll need to watch out for new entrants coming in, what sort of product positioning is happening, so that once the recovery comes in, do the listed companies actually benefit from it?
Yeah, actually, I wonder, Darshan, Pramod, both of you, I mean, if car ownership is a question mark and if shared mobility is a truth, then hitherto, I mean, at least my experience in the last few days, there are a number of Tata cars which are making a bit of a comeback in the Ola Uber fleet as well. And therefore, would Maruti have as clean a runway in that segment as it probably used to have in the past?
Could be, I don't know, because right now no one knows, because a lot of, and especially I think most of the cars, Ola, Uber, I've seen are Toyota cars. I haven't seen much of Ola or Uber go in for a Maruti. Probably there could be some Wagonars, but I think a lot of other options are also available.
Also emerging.
What's your sense of which sectors are you inclined towards? If you're saying someone has to invest for, let's say, 2 or 3 years, which are the right sectors that they should start accumulating, and which is the sector that, it's a clear avoid for you?
Well, I mean, we invest from a bottom-up perspective, so we go wherever there is structural visibility of earnings from a long-term perspective. And at this stage, assuming that the economy remains by and large in the same shape, I think consumption and private sector banks would rank high up the order from our pecking order perspective. Because it is the demographics which is a given in some ways, and the demographics will ensure that the consumption growth will remain stable, albeit through some cyclical ups and downs. That's one clear visibility of growth. In fact, even if an investment cycle were to come back, the bigger beneficiary will be the consumption story, because that will lead to job creation, income generation, disposable incomes going up. So whichever way you look at it, from a safety perspective or from a growth perspective, consumption will remain right up our pecking order. Alongside that, I think some well-run private sector banks, again, because of the structure of the financial system in this country, we've seen the issue of public sector banks giving way to private sector banks. We had the NBFCs come in and take some share in some categories. Even that is, we've seen a pullback now. The mutual funds which stepped in, they're also pulling back. So that leaves a fairly open space for private sector banks, which have had a very strong history in terms of managing asset quality. At the same time, very strong hold on CASA deposits, which pretty much underpin their ability to cherry pick assets without having to take extra risk. So those two sectors remain high up our order. I think what to avoid at this stage, like I said, unless and until there is a recovery in investment cycle, anything related to that, we'd hold off on, be it construction, real estate, metals, commodities, and so on.
Well, we'll try and tackle that issue on the other side. Pramod, thanks so much for taking the time out and speaking to us. We really appreciate